how well did all those commitments actually get fulfilled on our financial statements. So then we have evidence for investors and creditors as to how good our reporting was. And if a lot of our commitments didn't get fulfilled, then we know we were either not reporting accurately or we've got a problem in our business operations where things aren't getting followed up on and actually getting fulfilled.
Right.
Leaders Talk, Season 2.
Hello, everybody. Hello, and welcome back. It's your favorite time of the week. It's my favorite time of the week. It's time for Leaders Talk. And as always, I am your intrepid host, Andrew Dupy, head of communications here at Leaders Brands. And today with me, I have a special guest, and that is Dr. Cheryl Dunn. Cheryl Dunn is a PhD in Accounting Information Systems from Michigan State University. She's currently on a leave of absence from her position as a professor of accounting at Grand Valley State University, working as an ontologist at Semantic Arts Incorporated. If that name is familiar to you, you're going to understand why in just a second here. Cheryl has presented her research at many accounting and information systems conferences and written many articles for scholarly journals. She's also co-authored 2 textbooks, Financial Accounting, Keeping Score for Business with Christopher Harper, and REA Accounting Systems and Analytics with Gregory Girard. Cheryl's research is focused on trying to transform accounting practice, and when she saw Dave McComb present the Data-Centric architecture and the GIST ontology at a conference, she also saw clearly that the future of accounting is data-centric. Dave and Cheryl and the Semantic Arts team have been developing and implementing a data-centric accounting at Semantic Arts as a proof of concept. And importantly to us, Dave and Cheryl are co-authors, and this is where you're going to remember everything, of The Future of Accounting. And we'll follow up that book with an implementation guidebook. So before we actually let you introduce yourself, Cheryl, I would recommend to our audience, if you haven't seen the first episode of this with Dave McComb, go check it out, because that's going to kind of give you the big picture of what the future of accounting is and what exactly that means for you, who is probably the business leader, the CEO. But Cheryl is going to help us get into the weeds and actually dig in to the nitty-gritty on this. Cheryl, welcome. So that's a good introduction. I think we got a good start, but let's know a little bit more about you, just so our audience can kind of get to know you.
So just for people who are interested, as well as being trained in accounting, I'm also trained fairly extensively in computer science.
Okay.
And that's why my degree is accounting information systems, because I had quite a few computer science classes as I was in my undergrad and master's programs, and also in my PhD program. So I did a lot of work with expert systems back in when that's what we called AI.
Yeah.
It wasn't
Back before it
quite
took over
intelligent enough to be called AI yet, but
Yeah.
we did call them expert systems. And so I had worked with those a little bit during my programs. And so I've always been interested in bringing more of the technology into accounting. And so when I was in my first job in accounting, I was an auditor with a company that was called Coopers and Lybrand. Now that's been merged with Price Waterhouse, so it's part of PwC. And we were doing everything by hand when I started working for them. Everything was with a 10-key adding machine and the 22-column green ledger paper. And we wrote all of the work papers out by hand when we did audits. And some of the clients that we worked on had computer systems and they produced reports from their computer systems, but we had to manually foot everything, which means re-add up the numbers that the computer generated to make sure that they were accurate. And one of the reasons I went back to get a PhD is because when I was working on one of our clients, I wanted to take one of the suitcase computers that we had in a closet that nobody ever used. I wanted to take that out on a job to do a fluctuation analysis.
I remember those from the 80s. Yeah.
Yes. They weighed about 50 pounds.
I actually had one in the closet for about 30 years that my dad.
Yep. I could pick it up and put it on the table, but I had to work at it.
Yeah.
It was a struggle, but at any rate, I finally convinced one of the supervisors on a job to let me take that out and use it at a client. And it was, she didn't really want me to, because she thought it would take longer to do it that way than it would to write it all out by hand. And her biggest concern was that no one would know how to use it the next year if I wasn't there anymore. And there's a
Right.
high turnover rate in public accounting. And so that was a legitimate concern. And as it turns out, I wasn't there the next year because I went back to get a PhD so that I could teach more people how to do what I knew how to do, because I
Yeah.
could see the applications for it in accounting and well beyond the little bit that I did with that one spreadsheet. But what I promised her is that I would do it in less time than it would take me manually. And if it did take more, I would eat the hours. And I said, in the time that I take, I will not only produce the work paper, I'll print out everything that I put into the spreadsheet so that it's there as if I wrote it out by hand. Only you'll be able to read it because it will be printed by the computer instead of my handwriting. And I'll still do all the red tick marks that we have to do to show that I re-added it up manually and all that stuff. And I will make a user manual explaining how to next year move this column of numbers into that column and then type in the new numbers in this column, and then everything will recalculate automatically. So the next year it would only take a very short time to produce the work paper. And of course, a lot of the work paper isn't just in calculating the numbers, it's in interviewing the client and asking for explanations for why did this number change so much. We would any number that changed by more than a certain percentage, we had to go and consult the client and ask, why did that change? And then we would look at things that should have changed in concert to make sure they were changing the way they should in concert and not contradicting each other and things like that. So that's a lot of the work paper, was that kind of decision making. And that part wasn't going to be enhanced by the spreadsheet. It was all the calculation stuff that was going to be made faster and
Right.
more accurate, really, because it's
Yeah.
being computed by a computer and not by a
Yeah, a
human
fallible
brain.
human that can even, I guarantee you, I know people that have been in math and all this for years. They still make simple mistakes on math. A
Yes,
decimal doesn't
exactly.
go here, you don't carry a number here, and all of a sudden the entire thing is off. The computer doesn't make that mistake, right?
Yes, exactly.
Okay.
And so I did all that, and showed her what I had done. I personally taught her how to do it so that if she was there the next year and I wasn't, she would be able to supervise the person that she would have doing the work. And her job dropped. Um, she didn't know how to use spreadsheets. Nobody else in the office knew how to use spreadsheets at that time. This was in the late 1980s.
Mhm.
And it just wasn't being done at that office, at least of that firm. And so she was really impressed. And then all of a sudden, everybody started asking for me to be on their client jobs. And I got put onto one that I didn't really want to be on because it was at a nuclear facility and I was a little afraid of being exposed to radiation or something. And so I decided that was a really good time for me to go back and get a PhD so that I could teach other people how to do this. And so that's my background, and that's what got me interested in data-centric accounting. During my program at Michigan State, both my undergrad, master's, and PhD, I did all 3 degrees there. And the reason I did all 3 degrees there is because Bill McCarthy was a professor there, and he had an idea for what we call resources, events, agents accounting, or REA accounting. And he was using relational database technology to implement REA, and used that in his teaching. And I saw the value of that. I was really convinced that that was a much better way to do accounting than the traditional debit, credit, general ledger kind of model. And so I've been teaching that for 30 years. But then when I met Dave a few years ago and learned about semantic technology, I met him at a semantic technology conference. And all of a sudden, a light bulb went off of, oh, this is even better than relational databases. And it doesn't negate the REA model because the REA can be implemented in any kind of technology. There have been implementations of it in Prolog, which is a programming language. It's been implemented in hierarchical databases as opposed to relational databases. But the semantic technology, implementing it in RDF and OWL, it's a little bit problematic, and that's why we had to change it a little bit. And that's why we call it data-centric accounting, because not all of the concepts in REA came through quite cleanly enough in the OWL and RDF technology. But it has a lot of the similarities. It's based on business processes and the fact that there's a pattern underneath every business process that a company has.
Right.
And that's where the REA fit in. Where we differ a little bit is we really focus a lot more on the commitments that a company makes. And then that gets followed up with the economic events that the company engages in that fulfill those commitments. And we're very focused on, how do I want to say this? Can we do one of those?
Go, yeah, go for it. Yeah.
So we are very focused on putting the data capture for the company at the stage where the business activities are happening. And that's not inconsistent with REA, but it's not focused on quite as much with REA.
Right.
And the reason for that is we believe that the people that are making the commitments for the company are the ones in the best position to explain why did they make that commitment. Instead of them making the commitment, and in a traditional accounting system, those commitments don't even get captured. Unless an asset has actually changed hands, you've received goods or you've paid cash or you received cash or you shipped goods or performed a service. If you haven't done any of that yet, if all you've done is make a commitment to do that in the future, you don't make a journal entry in the accounting system. It doesn't affect your assets, your liabilities, or your equity.
Right.
And so it doesn't show up. And we believe that that's important information that investors and creditors really should be interested in. And of course, the reason that traditional systems don't capture those in the accounting system, they'll capture them somewhere in their ERP system or somewhere in a customer relationship management system or one of their other systems. They are capturing that data, but it's not hitting the general ledger. It's not hitting any of their accounting records. It's not reported on their income statement or their balance sheet. And so the investors and creditors will never know about it until it actually gets fulfilled and becomes
Right. Yeah.
economic events. And so what happens is the commitment will get made. It will be captured in some kind of a system, but not the accounting system. And then by the time it gets to the accounting system, now you've received cash or you've paid cash, you've received goods or you've delivered goods, you've performed service or received services. And an accountant is then going to make a decision about how to classify that thing. And they weren't involved in making the decision for that thing. And so they have to do their best use their best judgment on how to classify it. And accountants are pretty good at it. I'll grant
Right.
you
I mean,
that.
yeah, that's what they're that's what they do. But
Yes,
yeah.
it is a large part of what they do, but there's no need for them to try to translate because the person that made the decision is the for sure expert on what is that thing? Why did they do it? One of the examples Dave gave in his interview with you is when you buy chocolate. If you're a cookie manufacturer and you're putting chocolate chips in your cookies, then that chocolate is probably a raw material. It's probably an ingredient in the cookies that you made. Whereas if you bought the chocolate to give away at the end of the tour of your chocolate factory, then that has a different classification. It's not a raw material. It's actually a supply that you're using or a marketing giveaway or something like that. And the person who bought that chocolate is the one who knows why they bought it. They know whether they bought it to
Right.
use as a raw material or whether it was for the end of the tour at the chocolate factory. So Dave gives a great analogy that I love, and so I'm going to share
Yeah,
that one
I
with
know,
you.
it makes it make sense, and the thing is that knowing what he said and what you're saying, it's making sense to me. And as we discussed, I'm a
Good.
layman on accounting. Numbers is not my thing. English, history, publishing, writing, coaching. I'll go on and on about that all day long. Philosophy, even accounting, no. But
Yeah,
makes
yeah,
sense, and that's why this fascinates me to the point that it does because I didn't realize, even though I've worked in business for decades, that that side of things was so siloed and was so strangely disconnected, and you have to have so many moving parts. Now I understand why there are people that get away with stealing from the top, or why companies suddenly were like, why is our bottom line gone? What's happened? Where did the money go? And it takes audits. And I remember a business I used to work in, we had to bring in auditors sometimes when money was not where it was supposed to be. And they would come in and they'd be in a room for days and days and days and days.
Yeah.
Um,
Yeah, and those were probably what we call forensic accountants.
yeah,
And the forensic accountants are the ones that really dig in and investigate and try to figure out, okay, if fraud happened, where did it happen and how did it happen and why did
yeah.
it happen?
But the
Whereas your
vast majority of
financial
time, it's not
statement,
even fraud. The vast majority of time, it's what we said before. Somebody didn't carry a number,
a lot
the
of times it's
decimal's in the
mistakes.
wrong place. And that's what usually, after spending hundreds of thousands on having audits and things like that, and all the money that you have to do to get it done, and the time that you have to spend with everybody going in, your CFO's probably out of the office for like a month. Um, After
Yes.
all of that, suddenly, oh yeah, you didn't carry it. You didn't carry the three. Yeah, that sounds horribly
Yeah. Yeah.
efficient.
Yeah. Human errors cause a lot of problems with financial statements as
Yeah,
well, yes. So it's not always fraud, but the forensic accountants come in there and really try to figure out
right,
what happened that went wrong when something is identified as having been wrong. Whereas the financial statement auditors come in, and even if something didn't go wrong, they're responsible for doing some testing to make sure that the financial statements are fairly stated in accordance with generally accepted accounting principles. That doesn't mean they're 100% accurate. And
right,
it doesn't mean that they caught every fraud that could have occurred. And so that's something that a lot of people don't realize. They think that if it's been audited, it's perfect. And that's actually not the case.
right.
Um, and the reason that the accounting systems didn't capture those commitments is because they weren't considered to be verifiable enough. They weren't
Mm,
reliable. When you book a sale after the goods have been shipped and you book the cash when it's received, you know what happened. It's very
mm,
verifiable. It's very reliable. Whereas, owners that wanted to make their income statement look better, if we put committed revenue on their books, they can say, oh yeah, that customer promised they're going to buy this from me, and just put it on there. And then of course, oh, they changed their mind and they're not buying it from me after all. So, accounting, we don't want to put that kind of thing on the books as if it's gospel and have people counting on it and making their investment decisions based on, these things that may or may not really get fulfilled. And so we're
right.
going to have some guidelines for when is it really a commitment? When is a commitment solid enough that you can actually put it on your books? And then the other thing that we're proposing that we do is we make some kind of an allowance for wrong guesses. They're not really guesses, so that's a bad word to use. But if we say, okay, we've got these customer orders that we've received, we've got the actual commitment in writing, it's a legal contract, it's enforceable, that they're going to buy this many items from us on this date. We're going to ship them by this date. Here's how much they're going to pay us for them. Here's what the payment terms are going to be. We've got all of that in writing, whether it's a written document or an electronic agreement. Even then, things sometimes go wrong, right? Just
Oh
like
yeah, yeah.
even when we book a sale after the goods have shipped, if we haven't received the cash yet, we have something called accounts receivable. And
Mhm.
yet we still have something called bad debts because sometimes we're unable to collect that cash that the customers owed us. Well, we're going to have the same kind of thing with commitments. So we'll have some kind of an allowance for commitments that don't get filled. And then we'll need to have some kind of a follow-up. Okay, this is what we said were commitments last period. And then now that we're another period down the road, did they get fulfilled or not? And so we'll have some kind of a performance record or rating on how well did we meet that. How well did all those commitments actually get fulfilled on our financial statements. So then we have evidence for investors and creditors as to how good our reporting was. And if a lot of our commitments didn't get fulfilled, then we know we were either not reporting accurately or we've got a problem in our business operations where things aren't getting followed up on and actually getting fulfilled.
Right.
Either way, we've got a problem that's going to be evident to those investors and creditors. And so we're going to have some mechanisms for that in our reporting. And so we've created a proposed set of financial statements that includes commitments, but keeps them separated from the traditionally reported accounting numbers so that people can tell the difference between what's a committed revenue versus what's an actual earned revenue. And then over time, we expect that firms will get more and more accurate at making sure that they're only reporting those committed revenues that are actually going to turn into earned revenue as expected. And then same thing on the balance sheet. Right now, we don't have the same kind of contractual arrangements with cell phone providers today that we did 10 years ago. But 10 years ago, when you bought a cell phone, you would get the cell phone for free by signing a contract for 2 years or 3 years with the provider, and then you paid a monthly payment. And if you had that kind of an agreement, you wouldn't put that obligation on your balance sheet as a liability. It wouldn't show up. That fee that you would pay each month would just simply get recorded as telephone expense or communication expense or whatever your company called that thing. And there wouldn't be anything that said, oh, I'm going to have to pay $100 a month for the next 3 years because they gave me this phone and I signed this contract that said I'm going to only buy my cell service from them, at least for this device, for the next 3 years. Well, that's $3,600, right? Which to you and I is a fair amount of money. And it seems like if we were doing a personal balance sheet, that should be reported, right?
Right.
And yet we wouldn't. We would just record the $100 a month each month as we incurred it and paid it. Then we would report the expense. It would never show up as an accounts payable on our books or a long-term commitment on our books. That doesn't seem right to me.
No, it doesn't. That's what this is. I'm surprised that how many little inefficiencies that there are in, I guess, what's going to be called eventually the old way of accounting, because this sounds like the future of accounting. For me, when you're talking about this, when I very first, I'll admit, Cheryl, when I first talked to Dave years ago, when we very first met, we talked about, he said it's the future of accounting, and I'm like, okay, I've heard that before, and I've seen that before, and I don't really know what that means, but I'll take it your word for it. But then as I began to read to read some of the material you've had, and then to talk to him, to talk to you, really, this is the shift that we need to make that's going to help businesses become more efficient, to cut out the waste, to cut out the extra costs that have to come in to continue to go back and fix the books and figure out what departments are what, and to be able to actually consolidate something where we're actually in a world where we're accounting in a modern fashion. Would that be fair to say?
Yes, definitely. And it's interesting because the SEC recently had a call for comments on, they have a proposal that they want to reduce the frequency of required financial statement reporting for public companies. Right now, companies are required to report quarterly. So they actually, produce their financial statements and file them with the SEC every quarter in an official filing. And then only once a year they get audited. So their quarterly financial statements are not audited, but they do have to report them quarterly. And then when they make their annual reporting, that is actually audited financial statements. And they're proposing that companies have the option, instead of filing quarterly, to file semi-annually. And to me, that's going the wrong direction. Because really we should be getting rid, my opinion, is we should get rid of the idea of periodicity completely. So we shouldn't have annual financial statements or monthly financial statements or quarterly financial statements. We should have financial statements on demand. And so a user should be able to get a financial statement for any time period they want, whether it's a 15-day period or 38-day period or 6-month period or a year-long period. They can still get the traditional ones that they've been used to. But if they do data-centric accounting, that's going to be pretty much real-time financial reporting to the extent that we can get all of the business events captured immediately. If we can get the information captured as the events occur, then we can do real-time financial reporting. And we can also do continuous auditing. And if
yeah, that's what I was thinking as you were saying this, because that makes it right now with the system people use, that's too much work because you can't constantly be having all your departments talking, your buyers talking, everything all the time to have real-time updates. But with this data-centric model, you're going to, I mean, it might sound like you're having to do a lot of work at the front end, but on the back end, you're reducing a massive amount of stress on your people, on your systems, on everything by being able to have real-time accounting reporting and not have, the crunch time. It's like, oh my gosh, it's time, tax time is up. The quarter is near. We've got to get everything in order. And again, I've been in corporate executive positions, and I've seen what that's like. It's everybody's got their hair on fire for about a week.
Yes, exactly. And one of the analogies that Dave likes to use is the idea of thinking about today's systems as being like business activities being like raindrops coming down from the sky. And the way we capture them right now is we have all these different buckets. And so we'll have a CRM bucket, we'll have a production bucket, we'll have a logistics bucket. And we're, putting all these buckets in strategic places to catch these raindrops as they come down. And the thing is, once they get into those buckets, we can't differentiate them from each other because they're all mixed together. And then we take the CRM bucket and we pour it into the general ledger bucket. So we take the total of all that and post it to the general ledger. We take all the stuff that happened in logistics, isolate what's the accounting portion of that, and we dump that bucket into the general ledger bucket. And it gets all mixed together. In the general ledger bucket, at least it's separated by accounts, but still so you can picture we have mini buckets inside that big bucket for each account, right? But still the stuff is all mixed together, and it's really hard to be able to look at a number on the financial statement and actually say, what makes up this number? It's very difficult to trace, if not impossible, in most modern day systems, and was difficult in older systems as well. In a data-centric environment, what we want to do is basically freeze the raindrops. And so as the business activities happen, we want to freeze and like take a picture of each one and store it separately. And if the raindrops are frozen, now all of a sudden, if we put them into a central data repository and build connections between each of the raindrops so we can see how they fit together, that's where now we've got complete provenance of our data. We can go directly from the financial statement number back to the individual transactions that make it up. And we've got full traceability that way, which I think is really, really important.
And this is only possible because of because of the way that the technology is. It's only possible because of that giant laptop that you put down and started typing on and say, "Hey, look, we can do it this way." Because You're right. When you're talking earlier, I just thought of that. You couldn't do that. You couldn't do this with the way that even the way some places still use accounting with people that are still writing in ledgers, people that are still writing in sheets. Maybe they've got an Excel sheet and that's as far as they ever go. It takes an actual shift to the technology, which is what you're helping and what Dave's doing, to actually be able to bring this to everyone, really.
Yes, exactly. And
well, Cheryl, we could go on about this for a very long time because again, I'm fascinated by it, which I'm stunned by, because normally I see numbers and I'm like, yeah, okay, cool. But this is I really think you're onto something. But we're kind of running short on time. We should probably have all three of us on in a future episode to kind of dig even deeper into this, because I really think this is something that our audience should be looking more into. But as we wind down, what's maybe something you just want to leave our audience with? Maybe tell them what do you see as the future of accounting? Where do you see this in 10 years if this takes off? If everybody reads your book, which I highly recommend that they do,
I
and
highly
this
recommend
starts to
it
be
too.
something that's implemented nationwide, which I highly think is something that they should also do. What do you see in the future?
I see really much smoother financial reporting and therefore more efficient capital markets. The stock market, if this actually gets adopted by publicly traded companies,
Yeah, that's what I'm thinking about. Yeah.
yeah, the information that they have available as investors and creditors will be so much better than what they have today, that they might actually start finding financial statements useful again. Right now, they're useful to some extent. There are lots of academic research studies that will show, okay, if you make this kind of an earnings announcement, it's going to have this effect on the stock market. But they're finding very tiny effects, even if they have statistical significance. And if you just talk to people that are investing in the stock market, most of them don't look at financial statements at all and don't really see the value in them, don't understand them for one thing. And so we're hoping that that can change, that we can convince people that the financial statements really do have meaningful information. And because it's not just going to be all the stuff that happened in the past, it's also going to have some predictive value by
Yeah.
bringing in those commitments and showing the extent to which they actually get fulfilled over time.
Yeah.
And
And
so that's my goal is that we'll have a much more robust financial reporting system that will benefit investors, creditors, managers of companies will be able to get the data that they want. That's really our target right now, is to help the owners of businesses and the managers of businesses get the information they need. We think it's
right.
going to
And
be
then
a
and then
while
they'll
before
and then they'll see is that it's implemented what the benefits are for the long, especially that predictive. We didn't even really go down that rabbit hole yet about what we can do with this to be able to predict models for the future to actually help businesses plan better, which for the CEOs out there, that's what you all want.
Yes, yes,
I know, I know.
exactly.
I work directly with CEOs a lot. I know exactly what they say.
Yeah.
Well, Cheryl, let's put a pin in this one because I think I want to. We might want to come back and revisit that and maybe have a more of a future looking full episode if you and Dave can come on in the future. But until then, how can our audience find out more about you?
So you can go to semanticarts.com. And if you go to semanticarts.com, there are links for both Dave and for myself. And our email addresses are pretty simple. Mine's cheryl.dunn@semanticarts.com. And Dave's is just mccomb@semanticarts.com. And if you don't remember either of those names, you can just email office@semanticarts.com and say you want this to go to Cheryl or Dave, and they'll forward it to whichever one of us you want to get it.
Perfect.
So that's the best way. You can also look us up on LinkedIn.
Yeah.
We also both have LinkedIn profiles. And so if you just go on LinkedIn and search for our names, you'll find us.
And ladies and gentlemen, for your convenience, those links are down below, as is the link to the future of accounting. And I recommend very highly that you give it a buy.
You
There we
actually
go.
got it
Future of
here, so
accounting
you
right
can
there.
see what it looks like.
Yeah, give it a buy, give it a read, and contact Cheryl and Dave because if you're a CEO, if you're a business leader, I know that's what most of our audience is. This is absolutely the method for you if you want to improve your accounting system. Cheryl, thank you so much. Again, I really want to have you back on, and I wish you the best of luck with this because I think this is going to make it basically change the business world.
Awesome. Thank you very much, Andrew.
Thanks.